Thank you for watching this preview video at xm.com. We'll be discussing the upcoming Fed meeting and the potential reaction in the US dollar. I'm Maria Pachurdes, and joining me is Senior Investment Analyst Harlambos Pissouros. So Harlambos, recent data in the US continues to show the resilience of the economy. Can you tell us a bit more about that and how it might impact the Fed's decision on Wednesday? Do you think policymakers will hint at a March rate cut?
Hello, Maria. Yes, indeed, US data has been surprising to the upside since the December Fed gathering. But before we discuss how the data may impact the Fed's communication this Wednesday, I think we need to remember what happened at the December gathering. Back then, the committee decided to keep interest rates unchanged and revised down its rate projections, with the median dot for 2024 being revised lower to 4.6% from 5.1%. Now, at the press conference following the decision, Powell raised for the first time the question of when it may be appropriate to start cutting rates. And this allowed market participants to continue pricing in more basis points worth of rate cuts than the Fed did that same day. However, investors began lifting their implied path at the turn of the year, and the reason was the encouraging economic data, but also remarks by Fed policymakers who pushed against an imminent rate reduction. Now let's discuss the data a bit more. The CPI report revealed that headline inflation rebounded in December, while the core rate slid by less than expected. On top of that, retail sales for the same month came in better than expected, and the flash PMIs for January pointed to further improvement in business activity at the turn of the year. Adding to the bright picture was the first GDP estimate for the fourth quarter, which showed that the US economy grew by much more than anticipated. So, with all that in mind, and also taking into account that in the minutes of the December meeting, it was noted that most policymakers wanted to keep interest rates high for some time, I believe that now officials may not opt for rate reductions anytime soon in order not to risk letting inflation get out of control again. So they may continue pouring cold water on rate cut speculation.
So taking all this into consideration, what reaction might we see in the greenback?
Now, at the beginning of the new year, the market was nearly certain that a first 25 basis points rate reduction will be delivered in March. However, the latest repricing pushed that probability down to 50%, which means that there is room for further upside adjustment to the market's implied path, which means further room for lowering that probability even more. So, should the Fed continue to signal that they are not in a rush to start cutting rates, Treasury yields may continue their latest recovery, which could help the dollar gain ground. Having said all that though, with Treasury yields in some other major economies also rising and taking into account the improvement that risk appetite remained elevated at the turn of the year, the dollar may not dominate across the board. What do I mean? For example, any gains against the British pound could stay limited if the Bank of England continues to refuse talking about rate reductions in the UK, and the Bank of England meets this Thursday. I believe that given the Bank of Canada's dovish stance last week, the greenback may perform somewhat better against the loonie. And again, dollar traders may save some ammunition for Friday's non-farm payrolls.
Harlambos, thanks so much. This was a preview video here at xm.com.